As a rule, when times get tough for the average American, whether it's because of inflation or disease or war, whatever it happens to be, the Federal Reserve just ignores whatever the financial system wants and focuses on the real economy. We're not there yet. Every time the United States does something that some country finds annoying, everyone talks about the end of the dollar. But if you look at what has happened with the sanctions on the Russians so far, the Europeans have basically ceded their position in international currency control to the United States. And that means that they've joined in with the Canadians, the Taiwanese, the Koreans, the Japanese, the Australians, the Kiwis. There's only one currency anymore. And everybody really only has one place to go. Because if you look at the demographic structure of the world, the United States has the Millennials. That's a consumption base now, it's a production base for the future. That's great. If you look at most other countries, they don't have that class. So the tools you would normally use to shape monetary policy, primarily interest rates, do not work in a society where there isn't a lot of consumption. That's what you're trying to regulate primarily with interest rates. So the US Fed can still do that. Most other countries cannot, which means this tightening process that the Fed is going through is making an ever larger delta in terms of interest rates between the United States and everybody else. And currency markets are adapting appropriately. We've got $2.5 trillion in negative sovereign debt out there, and money is just flooding from that into the US dollar. So for the next several years, you should expect the dollar to go nowhere but up. Maybe not in a straight line, that would be way too convenient, but this is the future for at least the next half decade, probably more than that. Because remember, over the course of this decade, we're going to see a lot of demographic implosions, first and foremost in China. And that capital, once it has a chance to run, is going to run to someplace with rule of law and a lot of liquidity. There's only one option.
Now, when people talk about that kind of dollar strength, they call it the dollar wrecking ball. Because while it sounds like, oh, the dollar is going to go up and it's already the sort of global, currency of value. So, but it has huge implications for all the other currencies and for the rest of the world.
First and foremost, you're talking capital flight. During COVID, that was probably a little over $2 trillion a year. It's certainly going to increase. That is going to make it even more difficult for these countries to adapt to the changes in supply chains and demographics and economic norms. The second big thing, of course, is the debt market. There were a lot of countries, especially in the developing world, that took out huge volumes of debt in the 2010s when the US dollar was relatively weak to the global norms. We now see the other side of that, and you should expect a series of not just currency crises, but debt crises in at least the majority of the countries out there. And that is also unavoidable at this point.
And this is where it gets tricky because while on the surface, this sounds like a rising US after a transition period, everything's globally connected. We've seen what happens to the financial system when you have places, countries, large companies, large banking systems collapse, default, come under strain. The entire system seizes up, and it hits the US as well. Wouldn't that argue for the US staying engaged, staying involved, as opposed to retreating into some regionalized, even if they're growing stronger while they do that?
It's a question of what's the difference between the financial economy and the real economy, and there's definitely something to be said. As a rule, when times get tough for the average American, whether it's because of inflation or disease or war, whatever it happens to be, the Federal Reserve just ignores whatever the financial system wants and focuses on the real economy. We're not there yet. We'll probably get there next year. There's only three parts of the American economy that are internationally linked at all. One is tech manufacturing. That's all in East Asia. A lot of that's now coming back. Number 2 is agriculture, because American farmers and ranchers are just so hideously productive that they have to export about 1/3 of the calories that they produce. Finance is the only other one. And if there's one thing today's Democrats and Republicans agree on, it's that the financial world is not a group they speak for. So the political support that might have existed during the W administration or the Bill Clinton administration, that's gone. And we're looking at a system now where the government is going to be focused on the real economy, and what financials happen, or what the financial world does with that is what the financial world does with that. Now, with all the capital flight coming in, I don't think it's going to be quite so bad as you think. But there are going to be a lot of debt defaults that just have to be sucked up.
To watch the full video, check out the link in the description below. What do you think of Peter's thoughts here? Share your thoughts in the comments below, and if you found value in the content, hit the subscribe button. Thanks for watching, and we'll see you in the next video.